Valuations present a risk to the economy. Let's have a look. Hello everyone, Florian Heise here, and welcome to another episode of Heise Says. I've got my morning stein of coffee, and I thought we would have a look at this article from the ABC that was sent to me by several viewers. It's to do with valuations, and value could have a serious impact on how much super you really have. Now, before we go through this, I thought I'd put a contention forward to everyone. And I would say that incorrect valuations present a risk to the economy. I thought we'd go through this and discuss it in the comments below to see where I'm coming from and if you agree or disagree. So, that's the premise. Valuations present a risk to the economy, particularly incorrect ones. But a counter to that is that they're necessary to allow for the convenience of commerce, to allow for convenient commerce. It's much easier to just get information from a third party and say, oh, that's the valuation of it. We all agree on what that third party's evaluation is, so you don't need to go and assess the value of an item or an asset. It's much easier, it's much more efficient, and there's lots of benefits. However, there is a potential for conflict of interest to arise there, particularly on the third party valuation company, and we've seen that happen more and more often. So that's something that you need to keep in the back of your mind. So I'd argue that these incorrect valuations that are being presented and put forward on a variety of different things, fundamentally they're an incorrect signal here to the market, and they will influence the market. It's incorrectly signaling the market and influencing the market, because people will make financial decisions based on that information. We're seeing that just from auction clearance rates, So, but even though it's an incorrect signal, overvaluation of real estate has a positive effect on the economy. That's what we're going. Well, I'm going to put that in quotations because people say that all the time. That, high real estate or we'll go high real estate. Overvaluation / high has a positive effect because, the wealth effect of real estate is well documented. Okay, and we see our treasurer it feels like he's really pushing for that, is the continued wealth effect, and that it will flow through to the rest of the economy. However, increased consumer spending results in increased consumer debt. When people rush out and they have this perceived increase in wealth, which can evaporate as fast as it appeared, because an increase in a house is actually, is it actually real wealth? And all of this consumer debt, particularly credit card debt, that's future GDP spending that's been brought back, or future economic spending that's been brought back. So another counter to this argument is that home affordability is an all-time low. And household valuations in relation to household income are at a record high. And then I even question the validity of these valuations. And I've done a video here where we saw luxury apartments just in Melbourne had dropped 25% from off-the-plan purchases. So, there we go. And the issue is it can result in a housing bubble type Ponzi scheme where you need more and more investment coming in. And here is one of my favorite charts just from the Foreign Investment Review Board, where you have, at one point, over 90% of building approvals for new homes was from foreign investment. And that feeds into this housing affordability, which drives up, the wealth effect for everyone else, and will also increase the consumer debt. It all flows from one thing to another. And here's another issue that I wanted to raise because I think it's quite concerning. So the valuation, I'd argue, presents a significant risk to our banking sector, because Australian banks, they're required to have a capital adequacy requirement. And I've gone through it in this video here about fractional reserve banking, how we don't actually have it here in Australia. It's slightly different. And then I'd say the incorrect valuations could significantly impact the ability of the banks to meet these requirements. So if they don't have if they've got a lot of investment or mortgages on a range of properties, and they're fundamentally based on incorrect valuations, one has to ask what the potential consequences of that are. So that's the housing sector. But what about other probably well-known unicorns, should we say. You've got, companies or unicorns have been significantly overvalued. Now we're seeing that in the, in the stock market. We're seeing it in all these potential listings that are falling through. Recent examples are WeWork, Thanaros, even Uber. And just remember the internet bubble, guys. The internet bubble, how insane that was. And here I've done a video about the epic failure of WeWork, just showing how this innovative tech company, which was pretty much just a landlord, is insanely overvalued. So, and the problem with this is that you've got these companies overvalued, even either the unicorns or just the stock market. Resources are diverted from more productive aspects of the economy, and the same thing could probably be said for the housing sector as well. I'll just copy that over here, and we'll add that here. Oh, well, no, we won't do that later. So you've got institutions, pension funds, super funds, Australian wealth funds are making financial decisions based off the information that's been signaled to them from the market, from the valuations, which have a potential for a conflict of interest. Even retail investors as well are making investment here. So you've got two elements of the economy which are pumping heavily into these sectors, increasing their value and exposing them to risk. You also have, but you could make the counter argument, Florian, the stock market going up, it's good for the economy. It's good for the economy. Trump's always talking up the stock market in the US. It's going good. Look at it. Look how high it is. Everyone's super fund or 401k or whatever they have in the US, what they call it there, is just shooting up. You're wealthier. Go out and buy. But, the value of the stock market, I'd argue, isn't necessarily linked to the reality of business. In itself, it's a response to other things. You've got one, the market is attempting to anticipate moves so they can reap future profits, and share buybacks increases the earnings per share ratio, which artificially makes it look like a company is doing better. Now, Apple is a typical example of that. I did a video here where we looked at the recent decline in factory orders from the US and how it's in complete contrast to some of the large caps shooting up in the stock market. It doesn't align. So the market is responding to something else, not the reality of the business. So that's the contention I'm putting forward, and just a few little arguments I've presented to you all. And I'd like you to, let me know in the comments what you think, or if there's something else that you suggest I would add to this chart and this argument map. Now, I'll tend to do these with more videos as I come, and if you'd like a copy of this, or as they grow, you can get a PDF version from my Patreon and Subscribe style. I have to put a plug in there, guys, because I will, it'll be a good way for a good bonus for all the people who are choosing to contribute to me. But otherwise, just let me know in the comments your suggestions or what you would add or counters to some of the arguments I've put here. So let's jump back and have a look at this article, because I think it's something that we need to consider and we need to frankly be worried about. So, value remains elusive in this uncertain world. While leaders of the free world gnash their teeth and fret about the lack of information on household consumer items, the prices of assets continues to soar. Yes, it does. We've seen that. And just with the manufacturing orders fall and the S&P shot up. Anyone who doesn't own a house or a grub stack to play the stock market would have watched dismayed during the past decade as the lowest interest rates on record have supercharged demand for big ticket items and anything that delivers a yield. The ordinary suburban home is transformed from a place of shelter into an asset class that is becoming increasingly unattainable, and that's caused a huge widening in the wealth gap, destroying the myth of egalitarian Australia. Well, that is a very good point, and housing affordability is a huge issue. And remember, housing affordability, I would argue it needs to be measured on a household basis, not an individual basis. Because a household traditionally was a couple, and now couples both need to work to afford a house. Do you think that's an increase or decreasing quality of life? Let me know your opinion on that in the comments. So if your parents didn't own a house, chances are you never will. But it's not just values that are out of control. Valuations, particularly for things that can't easily be priced, have gone nuts to the point where they're headed into fantasy land territory. Why is this important? For a start, it could have serious impact on how much superannuation you really have. and the great valuation scam. WeWork founder Adam Neumann inadvertently blew the lid on the caper. His company, full of hot air and hype, was involved in the mundane but high-risk business of taking long-term leases on office spaces and then renting it out to short-term, mostly underemployed clients. A couple of months ago, his backers valued the business between $47 billion and $65 billion, and investors were clamoring for a slice of the action. By last Friday, the New York-based outfit's worth was slashed to just $4.9 billion, all in the space of a few weeks. Look at that. That's a 10x drop, pretty much. Given it loses more than $1 billion a year, you could argue that's still way too rosy. Well, yes, it is. That's just crazy. Crazy, their business model. We saw in a video I did yesterday where we looked at a shopping center down in Logan at Slacks Creeks. They had their own little serviced office there for $170 a week in a repurposed shopping center. I mean, there's no innovation to what he's doing. I mean, okay, his methodology of marketing it is probably innovative, but really. So, but why the wacky valuation in the first place? Each time WeWork's backers tipped in cash, they inflated the price of the business so they could book a profit on their brilliant lending and investment strategy. The plan was to flog the business off to investors who had been duped into swallowing the story. Well, there you go. WeWork was just the most recent in a long list of tech company floats that have been overhyped. That's why floats like Uber and Lyft are trading well below their market debut prices. Lyft. I forgot about that one. I'll add that one to my list over here. Wow. Never used them. Like many other newcomers, the value of these companies was nothing more than an arbitrary number plucked out of the air by financiers hoping to reclaim their original investment with handsome returns on top. And it continues in recent weeks as the various rich lists have been rolled out. Youthful executives of startup companies somehow have catapulted to billionaire status based upon the value of companies they control that earn very little, if anything at all. While the intrinsic value lies in their ideas rather than hard assets, putting a price on them becomes fertile ground for those looking to exploit the gullible. While industry funds have gone alternative. What? When industry funds have gone alternative? Are you kidding? How do you value anything? There's an old saying that something's only worth what someone is willing to pay. The problem right now is that a large number of buyers are willing to pay over the odds for almost anything. In an effort to escape the trap, there has been a trend in recent years for big super funds to shift away from traditional investments on stock markets and to what is known as alternative assets. When global markets tanked a decade ago and investors lost up to half their super balances, many big money managers decided it was time to diversify their investments. That's been particularly the case with industry super funds. They've looked for solid earnings in monopoly assets like infrastructure, real estate, and in more recent times, to plunge into private equity, taking public companies private. The graph below from research house Rainmaker indicates the stark difference between the approach between industry and or not-for-profit funds and the bank-run retail funds, particularly when it comes to infrastructure. So infrastructure in your spending. Here you go. Here's the industry funds. Here's the retail funds. It's a strategy that has helped stabilize the performance of industry super accounts by making them less exposed to volatile markets. But are they really? Publicly listed companies are valued every minute of every day the stock exchange is open. Private companies are not. They tend to be valued once or twice a year by a team of accountants or executives that make assumptions and guesses about value. And here we come, once again, to the potential for conflict of interest. And back as well to the information they have access to. Stock markets can be volatile and at times brutal. Occasionally during the height of a bull run, they can be incredibly expensive as they are now, or in the midst of a crisis such as the 2008, they can be ludicrously cheap. Given the reaction to the full gamut of human emotions, that's not always correct, but they are transparent. Well, yes, that's the issue there. If you value an infrastructure business at so much, that's a valuation. That doesn't necessarily mean you can instantly convert that over, or you can turn it into cash. Liquidity is different for these private businesses. So out of sight, but not out of mind. When financial markets collapse, the price of all assets are affected regardless of whether they are traded on public markets. During the crash a decade ago, listed property trusts were slammed as commercial property prices plunged and indebted companies came under attack. Unlisted or private-run investment trusts took a battering as well, even though the pain wasn't in the public eye. Many couldn't meet their commitments to pay out investors who wanted to bail out and were forced to freeze payments. That's also with some of the hedge funds. I think I heard a South Korean hedge fund recently put a stop on how much people can withdraw. And with some of them, you can only take money out at certain times of the year. The theory goes that infrastructure assets should maintain their value because by their nature, their earnings are more stable. That's because they often are monopolies and provide essential services that are less subject to the vagaries of markets or the whims of consumers. As a result, many industry funds include a big exposure to infrastructure into their balanced and conservative fund options. But infrastructure assets are big-ticket items. They're not easily bought and sold, making them what's known as illiquid assets. And that makes it difficult to pin a precise value or price upon them. The push into infrastructure and other alternative assets has been undertaken by IFM investors, owned by 27 industry super funds, which now has become one of the world's biggest infrastructure players. Unlike the disasters of a decade ago when Macquarie Bank and Babcock and Brown were paying ridiculous prices for infrastructure using vast amounts of debts, industry super funds these days employ a far more conservative and responsible approach. But in a world where everything gets overvalued, merely being out in the public spotlight won't be enough to protect us from a financial market shakedown. Well, there you go. There you go. I mean, guys, there is another aspect to it. What do you think? Do you think these valuations pose a risk? Do you think the illiquidity of these industry infrastructure investments will pose a potential problem to our super funds? Do you think the potential for conflict of interest in these valuation houses is something that needs to be considered? Or the consequence with the banking and the capital adequacy requirements that are required in Australia? Anyway, guys, let me know what you think. Like, share, and subscribe. If you would enjoy my content and would like to help me produce more, I do have a Patreon and a Subscribe Star. I also have a PayPal and an Amazon referral link where you can make a purchase and I receive a small kickback. Doesn't cost you a cent. Thank you all very much for your help and support. I really appreciate it. And have a great day, guys. Bye for now.